S&P 500 continues to crater right after the FOMC meeting. U.S. Treasuries dropped from 4.25 all the way down to 378 in 4 days. Technology names have been the hardest hit. Semiconductor index from its peak is actually down at this point 25%. But it's actually spreading. It's not getting better. We're starting to see the DAX crack here, which is EU's largest economy. And we can just see how we're starting to break down. So what gives? Welcome back, everybody. We have a lot to get into. To start with, we're going to get into the FOMC and what's going on there. Is Bank of Japan an issue with raising rates? It's a back burner issue at this point compared to the other things that we have going on. But most importantly, the ES, and we're going to spend a little time here. You can just see very clearly the tried to rally, then you form this little pattern, and then you break down. We could refer to this as a bear pendant. I really don't care what we call it. We can just all see what's going on. I made the 55 for us in yellow based upon your comments, and you could see how that finally broke. So we broke the 55. For people that don't know, I use a 55 SMA, and this marks institutional support. So let's deal with the facts, and then we'll get into the subjectiveness of this. But the facts are that we have lost institutional support here. Very similar to how we have lost it here in the past and then rallied back through it. And we lost it here in September and caught it back in November and rallied. Interestingly enough, I think it's notable that in November, the S&P was here and it moved based upon rate cuts. We are now here and we still have no rate cuts. The larger issue here is that a lot of people just really don't trust this Fed because they completely missed the ball before. And we're going to address that in some detail. The biggest thing for you is that at the end of this video, you will understand the macro, the fundamental issues, and the technical issues that you're facing for next week. That's the purpose of this video, so that you are informed. Of course, that makes our stool, and then this is obviously where we trade from. But we want all three of those so we can know what's going on. If all the investment banks have it, why don't we want the same tools? This is a little troubling to me because I have a left shoulder, a head, and a right shoulder. Now, there's also some more damage here that doesn't really even look like damage. But when you have a really weak right shoulder like this can get uglier faster. In other words, if you have something that is building up and then it breaks, yeah, it can break, but it usually will snap back a little faster. When you have no support here and you have no real interest here, this can get uglier faster. And now we're going to talk about some of the volatility indexes that you should be watching to determine that. But this is a very clear, and this is a classic head and shoulders pattern. And most people are going to see this, and should see that. And you're going to see the gap fill, and then you're going to see how we just ran right through the gap fill. These are the facts, and you are below from this level right here. You are below the 55. That's what we're dealing with. To be clear, under no circumstances is this normal for us to go from up here from 4.25 in 4 or 5 days to drop to 378. This is pretty much going to be the easiest trade for the rest of the year. And I don't see any reason to think that the guide is going to be lower yields. And we'll get as to why that's going to be the case. And again, no one really has any interest or any real support for this Fed because they keep missing things. And frankly, it'll become abundantly clear by the end of this video how they missed this. But on the stocks and the semiconductor front, you can just see the complete utter breakdown. If we put the simplest of indicators in, and there's the 55, I'm going to make this yellow in all the charts based upon demand, just to see it a little bit better. But if you look at the simplest of charts, you can just see the 55 is actually starting to curl down here, which is not what you want. And this is spreading. It's not just spreading here, but it's also spreading to Korea and some of the names over there. If we take a look at SK Hynix, which we will in a little bit here, and you compare that to Micron Tech, you'll see the roll, and it's pretty obvious what's happening there. Where are we going to find support in these names? I think you have to look at support globally, and we will address that. But if we go and take a look at, again, the simplest of things, the DAX, and you're breaking down left shoulder, head, right shoulder. And you're seeing the same pattern over and over again. And then the question will beg, for how long? How long can this go? And again, here you are. And then you can see your necklines right here. And it's kind of a crooked one, but it's there. And there's your breakdown. If we do, again, what I will refer to as the simplest of things, which is just say, hey, do we have institutional support right now? And the answer is going to be a glaring, absolutely glaring no. You lost institutional support, you were fighting it, and now you've completely lost it. And this in and of itself becomes an issue because then you start saying, well, where's the next level? And there's the 200-day moving average. Is that going to hold on the DAX? Because I want to be real clear about this. It's not just a U.S. problem when the U.S. has issues. It's an everyone problem, and you'll see this by someone who's a bond expert, and they're going to explain why this is the case. But we are supposed to be the stability debt instrument, and when we're not, and we move the way that we move in such a short period of time, and let me just give you one more data point so that you can see this, it scares what I will refer to as the bejesus out of people. So this is a 2-year treasury. This is not normal to do, to go from a 440 to 388. This means something's broken. This means somebody got it wrong. Now, the person that got it wrong was Jay Powell, and it's pretty obvious to everyone at this point. This right here, we always mark these off, and this is where the Fed comes out and they make their statement. No rate cuts at this time. We're going to stay status quo. And then as things progressed, you can see that at that 2:30, that's when the meeting starts, and you're just going to always watch these levels. This is where the high frequency traders are and the algos, and there's really nothing cleaner than this level. You know, everyone always talks about that it's so hard to make money because of the high frequency traders and algos. All you have to do is kind of mark off where they are and start using it against. Anyway, so you can see even how we tested the top of that. And then he starts speaking and things are becoming increasingly clear that there's an issue, but we're fine until the Q&A. And then the Q&A comes out with, if you're talking about cutting, then why aren't you cutting now? If you think that you're going to have to cut in September, why wouldn't you cut now? And he really couldn't answer the question. He's like, well, we want to see more data. But there's enough data out there that things are getting bad. And we're just seeing that data compound upon itself. And we're going to get into this. Again, by the end of this video, you'll know exactly what the issue is and then what you should be doing about it. But when we start to see these kinds of breakdowns like this, it always gives us pause. Because what we're seeing that this is the first reaction. So when you get to the Q&A in an FOMC meeting and he speaks, this is where you get your first real reaction to how people are responding to what he's saying. And then when you start seeing that the people that are actual journalists are going, and they do know what they're talking about, some of them, they actually get into the questions and go, like, why would you do this? Or why are you saying you're going to have to do multiple? He's using different language and people caught it. And they called him out on it. He didn't have an answer for it. And you can see how you dropped here. This is why it's so important for people to set stops on their trades, because when you have things like this, you have to know exactly what's going on. Most people had no idea where you were at here. Remember, 96% of day traders lose money. You have to do what the 4% are doing in order to make money. So then what you're seeing is that level. Now, if you were smart enough to mark off these levels and you knew better, then you would know that, okay, well, this is the top of the Fed meeting. We've been unable to get above it all night. All you had to do was watch that on Thursday, and it told you exactly what was going to happen. And you could see that. And that gave you a real clear area where someone could put on a short trade. We see when you start to understand this stuff and what's going on, it starts presenting opportunity. And I think that that's really important for people to get. But most people will look at these gap downs and they'll look at everything and they'll expect the status quo. And that's the problem here. And I want to spend a moment on this, because the problem that I see with people more than anything is that when you start getting into expecting just to gap fill and not understanding the macro issues that are going on out there, and there are a lot of macro issues, you need to understand what is going on and what the issue is. So we started with this issue on the macro side being the US and Bank of Japan and Bank of England cutting. And I want to be clear about this on the macro front so you see the issue. Because once you say it, it's like the Matrix. You can't unsay it. What you're going to see here is that you have UK cutting, you have EU cutting, you have Canada cutting, you have Bank of Japan raising. Everybody's getting themselves in position except two. The de facto debt instrument standard is doing nothing. It's a real problem. That leads to fundamental shifts in earning, and that's what's starting to happen. This is the what, this is who's affected by it, and then the charts will be reflective in that. Once that starts to happen, we get the three legs of our stool. This is where we sit and make our trades from, and sometimes we don't have to care about this. I long for the day where I don't have to watch every single FOMC meeting, but they've made a sport of it. So this is what we are. This is the hand we're dealt, and we have to play that hand. So what we're seeing right now is how our fundamentals going to be affected by what Itchy is doing. And what are you going to do with the technicals based upon that? Well, most people are going to look at this and go, oh, we're going to gap fill from here to here because that's what we always do. Not when this changes. Not when there's a fundamental shift in the market. Not when you're going through a degrossing as well, which we should talk about. Now, as much as we're filled with our own self-importance that we're going to mark the market and we're going to move the market and our ego gets in the way, the bottom line is institutions move the market. And this is how I was trained, and it works for me. And I would suggest that it would work for you. Understand that we are small fish swimming with big fish. We want to eat where they eat because they're making the kill. Now, this is called the degrossing chart. And this just tells you what are funds doing? What are they doing with North American equity? And Morgan was nice enough to put this out. Prime brokerage means that that's where institutions house their assets. And so that you know where funds keep their assets. Okay, so this is where we're at. And we can get into the hyperbole worse than the pandemic. It's not even. Pandemic is 2 to 3x this. and so is this area. And you could say it's here or there. What we do have is we do have just general, pretty disgusting puking of stocks, right? That's what you have. All right. So is it good? No. Is it worse than it's been since Jan 21? Yeah, it's around that area. It's about the worst that, pardon my voice, the worst that we've had since then, and I'm not going to have time to edit this stuff out. Okay, so that's the issue. All right, so if nobody's buying, then how are you going to do this, right? How's that going to happen? See, when you know all this, like picture having a puzzle and you have all the edges filled out. It gets a lot easier to fill in the middle, right? Instead of working from the middle and then trying to figure out where the edges of the puzzle are. So once you have the edges figured out and you figure out what everybody's doing, it makes your trading a lot easier. Now, I appreciate all your comments because it helps me create content. And one of the things was to start showing more trades. One of the trades to start showing were option trades. So we did an option trade on Friday on the index, and I wanted to have a short bias. I'll trade whatever happens. I'm not shy about changing my opinion. People in the community know that. But what I was doing here was looking for a puts to get involved. Sometimes I'll just do futures, but puts made a lot of sense here because I thought that the VIX was going to increase. And we'll explain that in a second, how you need to look at that. But overall here for us, I was looking for puts. So here, let's watch this. I'll show you how I did it. And then maybe this is something that you could look at replicating for yourself. So I'm going to walk you step by step through this so that you can see exactly what I did. So we have obviously the 830 bar, and we always know to mark off that 830 bar. One of the reasons for that is we just want to see where everybody is, right? So what we would just do is that 830 bar tells us where the algorithms are. And so you always mark those off. All right, always mark those off. And then the other thing that I tend to do with those areas is I kind of want to see those breaks. But the break of the morning is always the most important to me when I'm doing these kinds of trades. And so what I'm looking for is I'm also looking for key levels up here. So I have this 830 and I have that marked off, but you can see that the high, and then you can see even here, I always use the opening print too. And then I like to use the close and the low there of that 830 bar. But what I'll do is I'll go through that pre-market and look in the morning and see if we had any kind of activity there. And then what I'll do is I'll mark that off as well. So then I have these key levels marked off. And then what I'm doing is I'm watching. Now, I use the VIX a lot to determine areas of interest because you can find little nuances. You can actually do it also with options. You can do it with puts or calls the same way that I do it with the VIX. And I'll show you how to do that, but just bear with me. I'm not going to have time to edit this out. I got a lot going on today. But anyway, so you can just see this is where we enter up here. And then what I tend to do on these bars, as soon as I break, I'm out. I'm getting out. Instead of high-fiving the bros, I'm just getting out of it. And then as it's coming down, I'm pulling money out, and then I'm going from there. And usually these kinds of trades, I don't play around. I'll pull like a decent chunk out, like right off the rip. I just don't want to play around with them because they can just go to zero so fast. They're zero-dated options. But let's watch the replay on this, and then I want to show you it live so you can see how much faster it actually happens than what you're seeing here. Now, for time's sake, I sped it along, but what you're going to see is this area right in here, right? And that's the one area that we're paying close attention to. And we can see it even here a little bit as well, right? And so we've already gotten here. So here's the thing about this. I wanted to bide my time, and I used a secondary indicator that I'll show you in a second here as to why I was doing it and why I waited. But even if you did this here, and you did the retest and the failure here, there's still money on the way down. You never got over here. So you really never had any reason to close it. But we waited. And once we put that on, we saw the action. It became pretty clear that this level had the ability to hold. It's not just the test, it's the retest that I like the most with these kinds of names. I just think that they, pardon me, I just think that they work better. So then we're just letting it play out. And you're just watching it and seeing if it's going to break out or not, and I'll speed this along. So we're marking off levels of interest, right? This is a level of interest. Now, as soon as you start breaking down, this is really important. Once I start breaking down, that's it. It's go time. I'm pulling money out. I'm not cheering. I was right. It broke that level. I'm taking out a low. At the same time, I'm using a secondary indicator that I'll show you in a second. And then what are we doing? Well, then we're just trying to figure out how much we're going to make. And I know that I only have so much time on the day. Now, right here, once I'm up a lot, I'm watching the VIX. And I'm just looking at it and saying, this is getting it's accelerating pretty fast. How much more is this going to go? So I start taking a chunk out. I took a big chunk out here, but I'm taking partials here. And then I'm looking at it and going, okay, at this level, do I want to hold? Do I not want to hold? And then what I'm waiting for here is I'm going to see if I'm going to get over that area or not. And if I do get over that area, then I'm just going to hit a point with it going, how much more do I really think that I could make here? And at that point, I just look at it and say, you know what, let's just get out of the whole thing. And that's exactly what we did. Let's watch it play out live. If I was leaning one way or another right here, it's to start looking at buying like ES puts. Where's the SPY at? 535. What do you go? $2. Let's see. Give it more time. Let it figure out what it wants to be when it grows up. So I bought a bunch of the SPY 535 puts. Paid $2.50 for them. The SPY puts to me down 1%, 1.5%. I mean, you could have a 3% down day here. So I'm up on those SPY puts. If you're trying to figure out what to do with them, when you're pulling money out, go for it. I'm watching the VIX, and the VIX is hitting highs, and the market's not commensurate with that. But ES is moving and the VIX is moving higher. That doesn't really make a lot of sense, does it? We're watching the VIX hit highs while the ES isn't even breaking lows. So how's that possible? It's usually not possible. Usually if the VIX hit highs, then you get pressure because they're puts, right? That's what the VIX is telling you. That's why the VIX goes up. The VIX goes up because people are buying puts on the market. I think we're up like close to 100% on that. Come on, give me another bar down. All right. Closed half, up about 100%. I can leave the rest on all day. It's a free trade. 550. Would it pay 250? I'm up over 100%. Let's trim some. That's a big move, guys. That's what we want. This is what we want. Panic. Excellent. When you start looking at this stuff, like watch. See that? That's what you want. Because now you're at that April level, March. Like these are big, big levels. I closed the SPY puts. I closed these. I might be early, but I took the double. I had a lot of them. I'm just going to take it. I actually thought it could get worse, but this moved really fast. I don't know if you're going to 30 today or where you're going to go, but you're probably going to have some kind of snapback today. So just keep that in mind. That's a big, big move. Now, I hope you found that helpful, but what is important about that is you when you're doing those kinds of trades for me on these kinds of days, I want to watch the VIX. Because eventually what happens with it is it always comes home to roost. In other words, this always happens. You pop and then you always regress to some level. And this is really, you have to make sure that when this starts to happen, that you're out of your shorts. This is the type of stuff that kills option traders because they don't even understand why it's happened. And so by the time it happens, they don't realize that their options that they thought they were going to kill it on their puts or their calls, even if they're in the right direction, they're just bleeding out. And you see this a lot. But even some of the volatility indexes I tried trading on Friday, they just would bleed out because of this. Anyway, so the important thing about this is when this is going up, you just need to watch. I thought 30, a 3 handle was realistic, and that's where you got to. And then you would look at this and go, okay, is that going to be enough? And the question is, I don't know, and nobody knows. You go back to here in March 23, and you were at a 35. You start looking over here, and you were much higher. Now, where this gets super interesting is VIX height is relative to where it is. So what a lot of people want to do is they want to look at the VIX over a 3-month because you could just say, oh, we're at 30, therefore X. But then you go and look at the 3-month and go, well, November, we were here. April, we were here. And then you start looking at some of these other levels and go, well, in the 3-month, you're nowhere near where you're supposed to be yet. And this takes a little longer for it to move, hence the 3-month. Now, what a lot of people will do is they will take the 3-month and divide it by the 1 month. And this is pretty standard for people to do that use these indicators. And I'll show you the easiest way to do this. So basically, you can create this. And I actually have it as an indicator, but there's probably another indicator out there. Someone probably already did this. But what you're doing here is you're turning this into an indicator. And really what it does is it'll just mark key levels. Now, for me, this is a pretty key level because what it's doing is it's giving you the relativism of the move, meaning 3 months divided by 1 month, is this an area of interest? And that'll take you to that April level in 23. It'll take you to here, and then it'll even show you here in November. But this is real kind of, that panicky level. You can see that you've had a couple times here in 21 where you saw this as well. Usually when you see this, and it happens that fast, it can mark some kind of semblance of, hey, we're trying to form a bottom, or hey, we're trying to bounce. There's a couple things about this that make me think that that might be the case, and there's also some things that are telling me that we might not be there yet. So let's get into this. So below is a line, and this line is the 3x divided by, the VIX 3x divided by the 1. All right, and then if you look here, you're going to see some areas, what I would call them areas of interest on here. And I think that this is pretty important just to note, right? And you say, okay, well, these are areas where in the past, and we can do the simplest of things. Let's go here and we'll just, where is that? Stay in drawing mode. All right, so you'll just sit here and click on those levels and you'll go, well, that could be an area of interest. I mean, we've been here before And usually when we are here, we do hit some kind of bottom. And then again, of course, you just want to mark off that area of interest like here and just say, well, is this, how significant is that? And it's pretty significant as far as marking off these areas, you'd have to say. And so does that mean you go straight up? No, it doesn't. But it does give you some kind of going, okay, did we sell too far too fast? Remember, this market's like a cat in a hot tin roof. You have a Fed that nobody trusts. And so that creates massive uncertainty, warranted or not. Remember, the canary in the coal mine here was we had 7 cuts coming in back here, if you remember. Okay, so every time we turn around, these guys are doing something else, and then nothing happened from here, and the market's up, and now we're pricing in 7 cuts. And what happens if you get one piece of data where bad news is not bad news anymore? Bad news is now good news. Well, now you're in a completely different situation. So we're not sure what's going to happen, and when you're here, it doesn't mean that you miraculously just go up, right? Here you had an external force driving you up. Here you had an external force driving you up. They came in and solidified the regional banks. Powell changed his stance here. This is why it's so important to think of the stool. What happened here was just corporate buybacks kicked back in, and that you can see how that started to eventually move us sideways. Could that be the driver here? Because corporate buybacks just started again last week. Maybe, but this is important. Now, what gets me is I like looking at the extremes. Now, this is a tool, it's called the Williams VIX, and what they do is they look at the extremes. They will look at the highs and lows. And I find that level of volatility really interesting because it's also what the cloud does, the Ichimoku cloud. So this is kind of interesting to someone like myself. And when you look at these peaks or washouts, what I will suggest is, let's start over. And what you'll see here, and I believe there's an indicator out there. Should be a couple of them because there's a lot of Forex guys on TradingView. And what you'll see here is that level right there, right? So this will be out there, but you can see these levels and how they're accentuating. And the only thing that I would say about this when I turned it into a histogram, because that's how I would use this as a histogram, is I need a lower high. And I don't have one yet. I just have a lower low. So I would need, to have some kind of lower high in here, like all of these were, to tell me that maybe we're there. I do find this helpful because you can use this not only here where the VIX you can't, you can use this anywhere. So here's the Qs. And then you will go here and go, well, this is one of the most extreme readings that we've ever had on this, until you get back down to 22, right? And what happened down here? Well, they were much more extreme readings, weren't they? All right, so can this get worse? Yeah, it can absolutely get worse. When you go back over 4 years, this is a blip. This is nothing compared to what this was. So it can always get worse, right? But when you start to see these turn, or you start to see the green start going into this, and again, this is just a Williams VIX. Anybody can go and look that up. I do think it's very helpful to look at that tool and go from there. We covered a lot. And I really want to dive into what the heck is going on and what got us here. And then we should start looking at some charts so we're prepped for next week. But let's get into what the heck happened. So what exactly happened? Well, the best way that I can explain it is to start from the beginning. And what we're going to do is we're going to start from this date right here. And you can see it right here, August 1st. And what's important about this is it carries you forward to projected meetings and dates. Just mark that off. That'll be important in a moment here. But August 1st, you can see at the time that we recorded this. And we were comparing the fact that you were at 11% the day before. Now, for those that don't know what this is the CME Fed tool. And this is really important, and it's free. And what this says is, hey, what do the big dogs think is going to happen with interest rates? Because they're the ones that buy treasuries, they buy corporate bonds, they buy high yield, and that drives up yield-based products like cigarette companies or REITs or regional banks. And of course, them buying bonds does another thing. It also makes the lending cheaper. So we always want to know what's going on with rates. It's all connected, as we know. We always talk about the stool here, and as you're aware, you want to look at the macro, you want to look at the fundamental, you want to look at the technical, and then you look at it laying over like that, and you get your stool. And that's really how you should focus on your trading. You should look at all three components. But let's not digress, because there's a lot to go over. If we take a look here, this is September 18th, and this is from the 1st. Stay with me, because I'm going to show you how it started and where it is right now. And what we're saying is that there was a 100% chance you're at this right here, which is 525 to 550. We will explain why this is an issue. And we can see very clearly here how this was supposed to not only have one cut, but now there was a 22% chance of two. And then if you just focus on it, you go take a look right here on November as of the 1st. And the time recording, this is the 2nd. You can see the 21% right there. And again, This is telling you that you're going to have at least one, at least two by then. So they're telling you cut, then another cut, and then the possibility of two by then. So 125 and 150 is what they were telling you on August 1st. And of course, by December, it got even better. 550 to 525 is our area. And here's December 18th in that meeting. You can see that 5% is just a gimme, which they're saying at least 50 basis points. 75 basis points, 100, 125. Now, this is where it gets interesting. Over time, people got concerned after they listened to Powell's statement a few times. As a matter of fact, in the community, they're aware of this because I hopped on a live stream and I said, hey, listen, he's talking about cutting more than once. He's talking about several cuts, but he wants to wait to September. Now, this Fed has a problem. Their problem is they are always late to the party, and they've been late, and so nobody really trusts them. Now, today, the Federal Reserve interest rate cuts bets rise as U.S. jobs disappointing fuels growth fears. Non-farm payroll shows U.S. economy created 114 jobs, well below expectations, sparking speculation of an emergency interest rate cut. Okay, this is where it started, what I just showed you. Now I'm going to show you where it led to today after this. Now, these are headlines from The Guardian. And I thought that it just really kind of starts right here really perfectly. 7 hours, they come up with an article about 114,000 jobs in July, much less than expected. 17,000 of those jobs were actually from the government. If the government came in line, which was supposed to be 0 jobs, then you would have had your first under 100,000 number. And I do think they do this a little bit on purpose. They drab it out, they see how it goes. U.S. unemployment rises to 4.3%. We're not going to have time to edit this, and I know you guys don't care, but I appreciate your comments, and I appreciate you keeping it light. 21. All right, so yeah, that's not great, 4.3%. Look, this is the bottom line with this. We can sit down and we can look at this stuff all we want, but the bottom line is this is when people lose their jobs. And for lack of a better term, that's not great. Nobody wants that for anybody. Economists, Fed could be forced into intra-meeting move. Now, this is really a pickle, and this is the corner that they painted themselves in. Nobody trusts this Fed because they were so late to the party last time, and a lot of people don't realize how late. You have guys out there that are bond experts. I'm going to show you one today that you probably should follow on Twitter. If you are on Twitter, and just pay attention when this guy speaks, or if you see him on Bloomberg. His information's excellent, but he was saying even back in March they should have cut. I didn't agree with that, but I did think July they absolutely should have after that CPI number. But nonetheless, you can see how this goes, and then you're down 10% from the peak. Now, this is just an old-fashioned, we don't know what's going on, we're going to lock in what we want to lock in. And I'm going to show you how it actually looks to me that we might even already be seeing signs of a bottom here. But that doesn't affect the interest rate. It doesn't affect a lot of things, such as the interest rate trade, which I don't think a lot of people even understand that trade. We're going to go over it. So let's get to it. Now, what I want to do here is I'm going to highlight some times. So you can see right here, the 1027 summary. U.S. jobs weakness prompts investors to bet on rate cuts. Rise in unemployment to 3-year high. Lower than expected number of new jobs have investors ramp up their bets on Federal Reserve interest rate cuts. Let's call it what it is too, guys. You have an election year here, okay? You have an election year that's supposed to be highly contested. What do you think? It's in the bag for one guy, or you think it's a bag for the other person? It doesn't really matter, okay? When this happens, they can say that they're not biased all they want. Both sides of the aisle will be biased if they're in control. So will he do something intermediately? That remains to be seen. I personally don't think he will. The shift in financial market bets, Federal Reserve cutting interest rates visible when comparing CME Fed Watch tool. I strongly suggest you look at this. All institutions look at this, and it's an excellent tool, and it's free. I showed people how to do this on Wednesday, and they're explaining it to you as well. You look at the Fed Watch tool before an event, and then you look at it after the event, and it will tell you the weighting that they gave the thing, right? So you look at it before the event, you take a snapshot, usually the most recent one, and then you look at it after as well, meaning you would look at September now. Before the data, there was still certainty of a rate cut, but the chance of 0.5, 2 standard cuts, was put at 28.5. When I showed you yesterday, it was at 22. Now it's at 28. At 10:30, it's at 58.5 after the jobs number. So already it's doubled. More than doubled. If we go forward, investors have piled in the safe havens of bonds. They dumped U.S. stocks, fearing that a recession may be on the way and that the Federal Reserve may be behind the curve. I want to be really clear because I talked about the U.S. dollar, Japan, the yen. Yes, that's an issue. And it's very back to this issue. And this is the real issue where you can't raise prices, people start losing their jobs, and it becomes a real issue. Not only because they don't have the savings, but they don't want to spend it because they don't think it's worth the money to pay for something. That's the difference. The NASDAQ composite fell technical correction 10%, recent peak. Okay, this is the other thing that you're going to see in all these notes. Behind the curve. Are they behind the curve? I personally think they are behind the curve again. That's my personal opinion. I actually am interested in your opinion on that. Please comment below. Do you think they're behind the curve? I think they are. I do. I think they're the worst Fed ever, so I'll just leave it there. Among investors in economics, the question is whether the Federal Reserve has made a fabled policy mistake by cutting interest rates too late. Bear in mind, this is a U.S. election year. A recession and high unemployment would be bad for Kamala running against Donald Trump for U.S. president. Now, for those that don't know, Lazard is one of those white shoe investment banks, does a lot of M&A activity, and when they speak, it's worth paying attention to. The question is no longer whether or not the Fed will cut in September, it's whether the Fed should cut more aggressively than 25 basis points. Today's job report suggests the easing of tightness in the U.S. labor market is threatening to turn into weakness. The Fed was late to recognize the inflation problem. Let's hope it doesn't make the same mistake in the opposite direction. This is pretty much how everybody feels. You screwed up the inflation issue. Are you going to screw up this issue? And right now, the answer is yes, it looks like they are. Now, if you are on Twitter and you are interested in this, I would suggest you follow this gentleman, and you can see his Twitter handle right there. So when Bill Gross retired, who ran one of the largest bond funds in the world, it was called PIMCO, when he ran that and he stepped down, this gentleman took over for him. And he is pretty much the axe in all things that are in the bond market, understands it way better than probably 99.9% of all people on the planet. So it's worth paying attention to when he speaks. You don't have to agree with him, but at least you can understand where he's coming from. As the dust settles, economy and markets are left with the reality of 100 basis points move in Fed sensitive yield on the 2-year government bond over the last 4 weeks. So we have a 100 basis point move in the Fed sensitive yield in the 2-year in the last 4 weeks. To be clear, this is no way normal, especially given there has been some massive demand destroying shock. It is even more unusual for the superpower that is meant to anchor the core of the international system with mature institutions, credible forward guidance, and transparent policymaking. Indeed, it is sort of the volatility that undermines America as a global standing and its ability to inform and influence outcomes elsewhere. And to think this is all avoidable in the context of some serious thinking by the Fed and changes how it does view a few things, okay? He had an article out there about 4 weeks ago. So what we're seeing is, in a very short period of time, people giving him the benefit of the doubt, meaning Powell, to all of a sudden they're not giving him the benefit of the doubt any longer. Economic red flags. And this was part of the article that gentleman was just talking about. And I think that this is important. Today's jobs numbers confirm that something is going wrong in the American economy. And it's kind of an interesting way to start this. The new data suggests that the Fed should have started cutting interest rate months ago, according to Axios Macro author. Yellow flags had started to pop up in the labor market data over the past few months, but now flags are turning red. The big picture, the July employment numbers showed weakness across the board. October 21, the jobless rate is still low, but in a healthy economy, this kind of increase doesn't that year, and then you're seeing 0.6%. I'm not worried about that. I'll tell you what I'm worried about. You were looking for 4.1. You came in at 4.3. So that means that you don't even know where your numbers are supposed to be, and now you have one of the highest jumps in the unemployment rate that you've had probably in a long period of time between your consensus and your actual. That's a problem. And this is why I wanted to highlight the time so that you can see this. This is from Goldman, and this was a research piece that they put out from their economics research department at 10 a.m. Payroll growth slowed by more than expected. Unemployment raises for 3. And what do? Change their Fed forecast to 3. Now, they go into way more detail here, and I'm going to do it because I think it's important that you get this. Non-farm payrolls 114 in July, below consensus expectations. Industry composition was also soft. So not only are these the jobs, but now you have the industry composition. Healthcare was over half the jobs in July. Payroll diffusion index, lowest level since May 2016. So they have a payroll diffusion index, and that fell, and that's the industry composition, and through that payroll diffusion index, lowest level since May 2016. Household survey was also soft. Household survey is another way of looking at non-farm payroll, and it counts double jobs, things like that, and part-time work. The unemployment rate increasing here, 2 bips to 4.3. Note, hurricane. What about the hurricane? No discernible effect on the national employment and unemployment data. That's an issue because of the weather. Now, that they're saying it was for a household survey. The number of unemployed workers temporary layoff increased to 49, accounting for 70% of the increase in the overall unemployed workers this month. Our estimate underlying pace of job growth on base now stands at 146, adjusting for undercounting of immigration official statistics. Hourly earnings increased 2.2. And that was below expectations. So not only do you have less jobs, they're working less. Our estimates of the underlying pace of hourly earnings growth stands at 3.9. Today's report indicates that softening labor conditions has now gone beyond the amount that was welcome. So this is important to get. This is when we talk about when does bad news become bad news. For a while, bad news was what? Good news, because it meant rate cuts. The problem is that the pendulum swings, right? So when that pendulum swings this way, it's fine. It's when it swings too much and then you wind up over here doing this. That becomes the issue because then you have to come back down. And that's where that's the devil's in the details. Soft landing is pretty much out the window right now, is what people are saying. Now, we went through this in November before, and then all of a sudden it righted itself. So does that happen again? No. But people are going to think that it might, and I don't think that it. As a result, we now expect initial string of consecutive cuts. So Goldman is September, November, December, and then they're out for the next 3 as well. We think the slowdown in the job growth in July reports overstates the decline of the underlying trend. That would be great. But if the August employment is also weak, confirmed slowdown in job growth, then 50 would become likely at September meeting. To be clear, Morgan and Citi are now saying 50, 50, 25 after today. And now they're moving from 25, 25, 25. So you're going to see something when we show you the change in the past 24 hours on the Fed tool. And then I will tie this all together so you could say, why do I care about interest rates? And what does this have to do with my NVIDIA position? And we'll get to it. But this is more important. The US yen, yes, it's an issue, but this is the prevailing issue that will be on everybody's mind. So if you go back to the beginning 15 minutes ago, we talked about this. And we showed this at a certain level. Now you're at 71%, and you can see right here, you started at 22, and now you're at 71.5. That's a day. You tripled, more than tripled, the probability of 2 rate cuts in September. That's how bad today's data was. It wasn't just Japan dropping the way that it dropped. It was what happened with non-farm payrolls, them tearing into non-farm payrolls, that diffusion index that nobody's talking about, because no one goes through these numbers like these banks do. Remember, macro, fundamental, technical. That's why you have a stool. That's why Goldman has an economics department. If all we ever needed was just technicals, Goldman wouldn't have an economics department. They wouldn't have a fundamental department. Remember, you look at it this way. You go, what happened? Who does it affect? And when do we take advantage of it? What, who, when? And that is macro, fundamental, technical. Then you just overlay it this way. And then you're kind of teetering on your stool while you're sitting at the bar and you don't know which way to land. But that's the game. Sometimes you're macro and sometimes you're technical. So if we look here, we can see how this increased. Now, what did it do to November? Well, November, right there, and you can see, here's your 5.5. You go out here, you have a 42% chance now of being at 450 to 475. And you can see that right here. And then you have a 48% chance of being here at 425 to 450. Okay, if you look at that, that's 100 basis points in the next 2 meetings. So you have a 48.2% chance of being at a 100 basis point cut in the market by November. You're in August. That's a massive move. Take it out to December, and you can see really clearly right here, 12%, 46, 34. Okay, how does this all tie together? 525, 550, we're gonna hammer it out again. That's 100 basis points. Okay, that's 125. So when you think about this, they're saying that, with pretty much the de facto standard right now in adding this and this together is somewhere between 125 to 150 by the end of the year now. This is a drastic change to what we thought we were dealing with the day before. And you can see the numbers here really clearly. There was a 2.6% chance of this yesterday. And by the end of today, you have a 46.2% chance of this, 125 basis points. And you had a 0 chance of 150, and here you are with 12. So you went from a 2.8% chance, or 2.6 rather, percent chance of being in this range between 125 to 150 in cuts, to December that you are now well over 50% chance of between 150 to 125 in cuts by December. That's why this is so significant. Now I'm going to show you how you can calculate where this is going to drop to, meaning how they're really going to cut and how they're figuring this out, and also how they're figuring out the time frame. But I just want to show you something that you can use for yourself, and it's a very simple equation. We're doing this in the community already, but what you would do is go, okay, how much does this matter to bonds? And this is why it's important, because this will tell you the kinds of moves that you can expect. So what it is, it's the duration of the move. So in other words, you take the years of the duration of a treasury and you times that by the amount of the move. So for our purposes, we're going to say that the amount of move is 100 basis points or 1%. You then are going to get a number. That number, in this case, would be years times 1%, and that's going to give you the price movement. And that's going to tell you roughly where they expect bonds to go. It's pretty straightforward. As the price rises, it's because they're cutting the cost of the bonds. You have expectations that'll be built in too, right? They'll start buying based upon those expectations. But what you could do is you can overlay CME Fed tool like we did and say, okay, well, this is how much you've moved in that period. So how much could possibly be left? So in our scenario, we're going to use the 20-year bond. And so you're going to say 20 years, and I'm just going to make the math simple, even though they're saying 125 or 25%. We can play with this, but you're going to get it and say, okay, so 20% move. So what you would say this, and if it was a 10-year bond, for example, this is the 20-year. If it was a 10-year bond, you would say you'd get a 10% move for every 100 basis points that you cut. And then if you get to 150, you would get 1.5, which would give you 30. That gives you an understanding. But if you were to say, okay, well, status quo is X, and then we come into the Fed meeting and that puts us here, then you could say, all right, that puts us here. And then from here, we've already moved 3%. So from there, you would say maybe we have another 15% to go. And we're just ballparking it to give us an estimate. And then you would realize where that could put this. And what's important about this is that's usually what happens over time if you look at this. In other words, if you back tested this and said, well, when they hike, and go look at when they hike at the fastest pace that they've ever hiked before in their lives, you would see that it would fall pretty much the same exact way on how much they hiked. And this is why regional banks got in trouble. Now, what's so fascinating about this to me is that when you overlay this, this is why people buy TLT. And then other people will buy TMF. And a lot of people in the room were buying that today and buying calls on it. And I get that because they're getting the leverage. For me, it's just such a simple trade, because you understand that no matter what happens, you don't have to worry about earnings. You don't have to worry about anything. As long as they cut rates, this goes higher. It's really that simple. And so people will say, well, geez, how do you hedge this? Or how do I hedge my equity portfolio? Okay, start looking at things like this. It starts to make a lot of sense. The other thing that you'll start seeing is names like Philip Morris or anything that pays a really good yield. People will start looking at like XLU and they'll start looking at the utilities. They'll start trading up because all of a sudden yield is worth more. In the past couple of weeks, we've seen more money come out of money market accounts and start going into things like SO or Duke Energy. And that will continue. And the reason for that is exactly what I just showed you. If you use that equation, you could go through the 10-year and figure out how the 10-year is going to move as well. And you can start seeing why you're dropping the way that you are. Now, what's so interesting about this is you can see 380 here on the 10-year, and you can see how fast we imploded already as what there's because of what I showed with the CME Fed tool. That's why this is moving the way that it is. But it's just getting started. So if you take a look at the 10-year, which you have at 380 right now, take a look at the 2-year, and you're going to ask yourself, let's use the 2-year, and you're going to ask yourself, well, how much could these really move, right? And you can see how we're just completely imploding here. Now you're at a 380 because everyone's just buying yield. Why? Because they know the prices of these bonds have to go up. I always buy the long end because the long end is basically like the end of the dragon's tail. It's going to move the most. And you can tell that by what? You can tell that by the equation I just gave you. But how much do they really have the ability to move? And this is where it gets super interesting. If you go here and go Fed funds, I'll give you a real quick rundown of this the other day. One of the things people are really missing on is the fact that from 2008 to 2022, you had zero interest rates. You had a couple little upticks here, but this is 1%. By the time you were here in 2018, you were in full-blown panic, and then it went back to zero again. But people that have been trading don't understand that why their margin, all of a sudden they have a margin interest rate, and you can see that here very clearly because it's tied to Fed funds. Fed funds, for those that don't know, that's just really banks borrowing from the Fed. Okay, think of it that way. But when the banks borrow from the Fed, what do they do with the money? Well, they're supposed to go out and buy treasuries. But if you're borrowing at 5%, and then you just take a look and say you're supposed to buy the short term, and this is where the regionals got in trouble in March 2023, there was nowhere to go. And what they were doing back here, if you remember this, remember how yield was rising? Yield was rising because they kept raising rates. Well, the underlying portfolio was going down. So their underlying, they had what we were referring to as unrealized losses. And you'll remember what happened here where we were going to lose every bank in the world and regional banks and et cetera, et cetera. And that's obviously not what happened. But why am I bringing this up? Well, the exact inverse is going to happen. And people are kind of acting like that's not the case here. And I'll get to that in a moment. But if you realize that the Fed is lending money at 5.3 and that they're expecting banks to go out there and buy treasuries at 3.8, how do you make any money? But if you take 5.3 and you minus 3.8, you can see that you're roughly at what? 150 basis points. And that calculation explains to you exactly why people are leaning towards 125 to 150 basis. It's just a question of when, and they're saying that, it's got to happen within less than 2 years. I hope that makes sense. You can always comment on it below. Let's get to this. So I find this absolutely fascinating because when we look back on this and we understand that we broke down here because yields were rising on the 2 years I just showed so fast. Yields were rising so fast that they were having what we refer to as unrealized losses on their portfolio. Well, now the exact opposite is happening with banks. And what are they doing? They're selling banks. Why? Well, we're worried about what? You're worried about the consumer? What about the unrealized gains that they're about to start having on their entire portfolios? Okay, what about the fact that their entire commercial real estate portfolios that were supposed to be at risk are no longer at risk because now they can refi cheaper than they've ever going to be able to refi before? So I would argue that people are looking at this the wrong way with XLRE. And that might be why XLRE hit a new high today and no one's really paying attention to it. I find it fascinating that we saw names like SLG and V&O sell down because of office space in New York, and people are concerned about that. It's kind of an interesting place to be. You could see like SPG and look at that and say, well, I get that because that you're in the mall business, so that might make sense. Or you might say Vici could come in because what? Vici is in Vegas. They own the top 10 real estate places in Vegas. Okay. But why all of a sudden that these companies come down? It makes zero sense because they're going to be able to refi their rates cheaper. Well, you're going to go through a recession, so you're going to need less office space. You already have less office space. You can't have less office space than you've already had in New York if you go back and take a look at it. So you could argue like HPP maybe, right, San Francisco, LA, but even that, you're still trading at 27 cents on the dollar. Well, what happens when they're able to refi everything cheaper? Now, you could be thinking this is like 3-6 months out, and it might be. But I think people are sleeping on this, and we saw a little bit of panic associated with this. And this all extrapolates out even back into the IWM. You guys are welcome to comment on this below. But you look at the IWM today, which is flat on the day, and everyone's like, oh, we sold off so much. You had one down day. You had one down day where everybody panicked. And the bottom line is 15.9% of this is tied to essentially to financial services and regional banks. And they benefit the most from what? Rate cuts. But now people are worried about a recession. That hasn't even poked its head up yet. All they have to do is start cutting rates and then it'll start fixing itself. I don't know if we're going to have a recession. Let me be really clear. Nobody knows. Just like nobody knew in March of 23 that we were going to crack the banks. Nobody knew that either. So no one knows that we're going to have a recession. What they do know is that they have to cut rates or we're going to start having problems. And IWN benefits the most from that. Let's take a look at some charts. Okay, the best thing that I can do is to give you some charts that you should be watching next week. I would look at this chart. I would look at the VIX 3-month divided by the VIX. Anybody can do this. I would suggest that after you have a day like this, if you start to see not a follow-through day, but you start to see it start to hold, I would pay attention to that. Most people are just going to look at the VIX. They're not going to look at it relative to this. I would suggest that the relativism is really what you want to focus on. It can always get worse. The first sign that it's not going to get worse, you can see it here and here and here. It's all these were worse, correct? Okay, obviously that's rhetorical. So we don't want to just assume because you hit the same level that you hit a year ago or 2 years ago that you're done. You want to see and make sure you're done. Now, we did cover a lot on Friday. We did retreat a lot on Friday with the VIX. That did happen. So somebody might say, oh, well, that's it. I don't know that because we didn't turn red. We didn't completely sell out, right? We're still significantly higher than we were the day before. You closed at 18. You're closing at 23. So you're still significantly higher than anything. And quite frankly, that close, when you come here and look at it, is higher than anything. But I would start there. The other thing that I'd be watching very closely is I'd watch the 10-year. I would watch how bad this is going to get. So does this continue to drop? or not. And that's something you have to watch. I went through what names you should already think about looking at that are interest rate sensitive in regards to this, and I'll go through a couple more that I think you should be focused on. The key issue here for me is to take a look at that level and make sure if you break it, understand that that means interest rate bearing names are going to go higher. Keep that in mind. Now, for me, I look at what they're doing with the REITs kind of like a joke. We were worried about high yield, and high yield was going to kill us, right? That was all that we had to get out because of unrealized losses. What about unrealized gains? All the gains that they're getting from their entire bond portfolio as it goes up and allows them to lend more capital. Okay? And people are saying, well, they're worried about the consumer and the recession. So what carries more weight? The commercial real estate portfolio that all of a sudden just got bailed out because of what's happening? Because now they can go out there and refinance significantly cheaper? Or is it that we're worried about the credit card debt of regional banks? I would argue that the issue really is commercial real estate and that this is presenting an opportunity in the space. But that's just me. And then the home builders. Okay, is it going to be good that we get back to interest rates that are around 4% for mortgages, or is it going to be bad? All right, so if you start taking a longer term outlook to some of this stuff, well, no one's going to be able to buy a house because we're going in a recession. Okay, 72 hours ago, no one thought the word recession, and Powell was doing a great job. Now we're at 125 to 150 basis points in cuts. All right, so maybe someone's still going to buy a house. And so I would say that there are two areas that I'm focused on. Also, if you start looking at biotech and you start looking at the fact of the areas I just gave you three of, and you start looking at how those charts actually shaped up as the day went on, they're not really that ugly, guys. They're not really awful looking charts. They really just got back to support. So these are areas of interest that I think you should focus on. Now, as far as following tech and what's going on with tech, you're seeing some major breakdown. So we have the rally, we have earnings. Earnings were a dumpster fire. And then we tried to rally, and now we can't. But if you take a look at Tesla, what's really happening here? You take a look at the 200 and you take a look at the 55, and you're sitting right there. If you break this, you're going back under sub 200, in my opinion. So I would definitely watch Tesla, and I would definitely watch what's going on there. The other is NVIDIA, and you're already seeing articles about a delay at the time of recording this. They came out on Friday night, a delay on Blackwell, and NVIDIA is denying it. No one's going to play that game right now. Nobody. So this could cause some fear in the name. I think this 95, 96 level seems pretty realistic. Remember, 55, I'm not going to change it, but this should be yellow going forward. 55 is going to determine what? That is institutional support. Matumbo. So why am I telling it what it's going to do? I would focus on these larger names as telling you what's going on in the market. The other thing that I would focus on is Apple. Apple had a great quarter. They had a really good quarter, but you have a control bar here and you're having trouble getting in that control bar and staying in it. And I would watch this. Also, and you want to pay attention to this, Buffett comes out this weekend with his holdings. And then what you'll usually see is he going to be in Apple or out of Apple? Considering where the stock is, he's probably going to have gotten out of some of it, probably a decent chunk of it, and he's blowing out of Bank America, which is not going to really convince a lot of people that they should be in financials, especially the large cap financials, which I find incredible because everybody had to own them here, and now here we're all worried. And did things change? Yes, they did, but did they change that drastically that JP Morgan all of a sudden needs to be down here? I'm not so sure. I'm not so sure that this isn't going to present opportunity. But what we have to do is we have to start looking for signs of how are we going to determine where there's a bottom, right? So then if I'm going to go here and look at the SPY, I would suggest that I look at RSI, and this is what is somewhat troubling to me. And I'll give you something else to watch as well. Two other things. I'm not oversold where I was. So remember when we looked at the VIX 3-month to the VIX month? Both of those cases, I was oversold. I'm not oversold yet. So does that mean that we could go lower? Yes, you could. That's why I showed that we've gone lower before there. So what I would suggest, and I don't care if you use this or not, I use it, I'm very comfortable with it, is start looking at where we're getting washed out. And then I would suggest also looking at the Q's SPY, which is something that I do, and starting to see if you start to get oversold here, which you are, because Q's will move before the SPY because tech took it harder, right? We've already seen that. And you're already really pretty much oversold here. So this could be an area of interest where you start seeing the Qs start outperforming on some level. That could just mean not going, outperformance on a relative basis could mean just not going down as much, right? They could both be dropping, but one could be dropping like a bowling ball versus a feather. So you just want to keep that in mind. How washed out are we going into earnings this week? Because you still have some big dogs out there that are going to report. I would focus on that. The US dollar versus the yen. People are going to be obsessed with this trade. That should have popped right in there. Not sure why it didn't, but let's see if we can find it. Japanese yen. We'll watch it this way. So you can see that this is an absolute free fall. We're going to cut. They're going to raise. That's throwing off the carry trade. I've walked through the carry trade twice. I'm not going to get into it again. But is this good for U.S. equities? No, because the whole thing has to unwind. And it's not good for U.S. equities. And you can actually go back again and look at when this started. It didn't start because of Japan. It started because of us. It started like everything else on Thursday, July 11th, when we had a negative CPI number and the Fed just blew it off like it was nothing. And remember, the last time you had a negative CPI number was what? It was the pandemic. Now remember, RSP has been leading ever since July 11th when we go back to that date. Why? Because we started to see diversification. They all look like the same chart, essentially, until you drop in the zero line. So the question becomes, how bad does this market get? Here's what I would do, and I would watch this part very carefully to what I'm about to say. If we lose RSP zero line from CPI, this is going to get worse, and it could get a lot worse. Because the diversification is actually what made it worse, because the percentages went up on where people put money. They weren't in all the same names. They diversified because of this, and then it got worse. Now, there's areas of obviously interest rate sensitive names, which I would suggest you look at, like XLRE, but you do whatever you're comfortable with. But if you see this, you want to pay attention to this date, specifically to this date when the CPI was negative, and go from there. You can overlay that and just mark it right here and see very clearly how you broke it on Friday and bounced. That's a good thing. We want to make sure that we're bouncing over that. And I know there's a lot in this video, guys, but there's a lot going on out there. So it is what it is. There's your 55. I use a 12, a 22, and a 55. Use what you're comfortable with. I'm going to leave you with this. These are a percentage of stocks above their respective moving averages. You, on the short term, are finally giving way here, that you are setting up for maybe some kind of bounce, but you're still far off. I'm trying to give you hope where I say it, but I got to be honest, these need to really come down. Trough levels on like the 20 for a bounce, stocks above the 20-day moving average, are right around 5. And when you get a trough level like April or November, that was 10. That was here in April 26. I'm at 56. You start looking at the 200-day in November, I was down to 22. Now in April, that really didn't drop too much. You came down to 62, but you're still at 68. So while some things are pointing to, yeah, maybe we are going to, I think the diversification might have hurt us on some of these things, making us a little more overbought. That is it.